And hello, and welcome to another edition of Stonewood Study Group. My name is Neil Wilding, our COO here at Stonewood Financial, and as you can see, I'm joined by the guy that really runs the show here, Alex Stout. Alec is head of our member success team, and uh, how things going for you, Alec?
It's good. I got to make a note of that you said that. I'm going to save that one for later for sure. So
Your review. So,
thanks for letting me join on.
no, man, you're running the show. What we're doing today, what we thought for this study group is just keep it very interactive. So, I brought Alec on for this one because, we put Roth Done Right software out into the world for a good, 6 months now, 5, 6 months. And, he deals with our members that are using the software on a daily basis, fielding questions every day, hearing great success stories, great conversations with everyone. And we thought we would bring that to the masses via the study group here. So, format for today, we're just going to kind of keep it conversational. I don't even think we have prepared slides here. We got a few case studies or reports that he's run, just we could use to kind of fall back on. But for the most part, Alec and I are just going to talk. And if you all have questions or comments, we're going to do our best to man the chat on this one too, because we'd love to hear from you. So, Alec, I know that you've pulled together some of the common questions that you get when people start to consider Roth conversions or using our software. And so why don't you kind of start with some of the things that you've heard or common questions?
Absolutely. Yeah. Well, so hey, I've made a list here of kind of some common ones that I get from our members, but also what clients might be asking you guys and kind of the feedback we've got. So the first one, I think, to set it up, I think it's going to be a pretty blanket one. I want to give you a layup here, Neil. But if we're talking to clients, why should we consider a Roth conversion? Like, first and foremost, what's the reason for doing that? Obviously, we want to save some money on taxes, right? I think that's probably the short answer. But kind of expand on that a little bit.
Well, I think Roth accounts have been around since like the late '90s, early 2000s, and so initially, people were able, a limited number of people based on income were able to put some money into Roth. And now more and more over the last 5 years or so, Roth conversions have become quite the hot topic because people are looking at the tax environment that we're in, and they're seeing the taxes are artificially low. And also, we have people hitting the age we're actually using their IRAs and realizing these IRAs are building up all of these the tax burden that they have. And so I think what we're seeing is kind of a convergence of opportunity, tax policy, and reality of people using their IRAs and realizing the problem. So to me, the opportunity is to ask the question ultimately, do you believe the taxes could be higher in the future than they are today? It's a very broad question, but it's important to start broad, narrow in. And to me, the key word in that entire sentence is could, because could represents uncontrolled outcomes. And when we have uncontrolled outcomes, that represents risk. And if we have risk, then we have need for an advisor to build a plan. And that's where the opportunity presents itself. So to me, Roth conversions are a great opportunity to sit down with our client, expose some risk in their portfolio that maybe hasn't been mitigated before. Most portfolios, we've been a focus on market risk. We've done a good job in the annuity industry of offsetting sequence of returns and longevity risk. But if the majority of our assets are still deferring taxes into a perceived or questionable tax environment, then we have uncontrolled outcomes on that side of things, and that can mean less money in our pockets for our clients. And so to me, that's the ultimate reason to consider Roth conversions.
Yeah, and the only thing I'd add there is to the point you made about kind of reality and behavior, the timing of this convergence. I think for the past generation, it's been told that you save your money in tax deferred accounts, right? This idea that when you retire, you're going to be in a lower tax rate. And I think people that are approaching retirement are realizing that that might not be the case anymore, right? Either you've saved up these large tax deferred balances and maybe later on you're going to hit with RMDs that are going to tack you up, or your lifestyle that you're accustomed to no longer supports that, right? It's different than prior generations before of retirees,
Yep.
where that retirement today is not where you go to pinch pennies, right? So with that being said, who is like the target demographic? Is there a certain age that's perfect, an ideal fit for a conversion? Is there a window? Does it matter?
Well, it always matters, right? With any type of financial considerations, obviously, it always matters. We should start everything with it depends, but in general, sooner the better, right? The younger the client, the more because the younger they are, the more years that they have where they're subject to those uncontrolled outcomes. The more legislative change they'll have, the more elections that will be present in their lifetime and in their retirement. So the younger the better to start considering it. And I think when you use our Roth Done Right software and start looking at Roth conversions, the younger the client, the even more powerful the reason to convert becomes, especially when you apply the the assumptions that we like to kind of coach our members on using. When we apply the right set of realistic, reasonable expectations, apply some realistic, reasonable tax policy changes, the numbers start to jump off the page for the younger. Now, I know most of us aren't dealing with 40 year olds looking to do Roth conversions. Most advisors are working with clients that are a little closer to retirement. So then the question becomes, if I reach retirement, am I too late? And for many people, the answer is no. It also it matters. What's the purpose of the money? Is this income money? Is this IRA money that you're absolutely using on yourself and you're going to squeeze every penny out of that as you can to fund your lifestyle? Or do we have an adequately funded retirement or maybe even overfunded where we identify some of the assets that will be going to the kids? And to me, the more money that's even going to the kids, or just that we passing on through legacy, the more need to consider these conversion strategies. And obviously, that opens up the door not only for using annuities as the funding vehicle for the conversion, but also life insurance, where we can do a 5, a 10, or a life pay and convert those legacy assets into you know a, a, a value that carries a pretty significant multiple.
Well, and I want to add on that, or kind of maybe ask a follow up question. So one thing that comes up often is I think the thought of, when do I start this, right? If you got a 61-year-old client and let's say they're planning to retire at 65, well, the thought often is, well, should I wait until they retire when they stop, their current income might drop, right? And maybe they start taking Social Security or they got some other income coming in, but is that the best time to do it? Now, the other side of that is I think people sometimes feel like the point you made, is that too late? Well, if you got a guy that's 67, 68, 70, then we've got this crunch time window kind of before RMDs too. So, one, I guess the first part, is there a reason, or like, should we wait 3 or 4 or 5 years from now if we know they're retiring down the road to consider it then, when we can look at today's rates and say, hey, I know your income's going to be less in 4 or 5 years, or is there a reason we shouldn't do it, or we should just go ahead and start it now?
I think what you outlined, Alec, is the reason to use software, and perhaps no software better than Roth Done Right.
That's
I
crazy.
didn't mean this conversation to be a shameless plug. I mean, we want to, but I will tell you, like, it matters. It absolutely matters. It matters, and some of the variables that come into play here are absolutely income, right? If we are going to be primarily living on Social Security, and the IRA, and a little supplement to the IRA, and income is not going to be that much, maybe the standard deduction is going to offset most of your IRA income where we don't need to convert. Um, so that's where it's worth looking at for sure. And so the answer can vary. But if we have annuities in place and we have rental properties and we have other income that we have coming in, then the higher that bracket's going to be in retirement, and the more and that's, by the way, just looking at their personal bracket, right? But we also have to consider that's just situational. We speak ad nauseum about legislative changes. And it's very possible for you to be in a lower tax bracket, have lower income in retirement, but still pay more in tax because policy has changed. And we've seen a 20, 30% increase to income tax, or maybe there's more income related type stuff like IRMA, and other things that are impacting us. So, I hate to keep falling back to it matters. And that's why I'm
Sure.
glad later on, I know you're going to pull up some reports and we're going to kind of talk through some of the things that change. But it really can. It
Yeah.
can vary. Yeah.
Well, and I think that's a good lead into this next question. So, we've been talking, and some advisors have too. We've been talking saving money tax free for the last decade, and I know advisors have been talking conversions for years. And a lot of what we've preached has been, well, we have this window of time to convert. Well, recent legislation passed, and if you want to hear more about that, on the last study group we did, Becky talked about the big beautiful bill. It's on all your Stonewood accounts. But recent legislation passed that extended these tax cuts now, and so we've kind of thought, if you were talking to us 4 or 5 years ago, that we had until 2025, right? Well, now the new legislation says that those are, I'm going to use quotations, indefinite, right? We don't have an end date in mind. So two parts.
Permanent.
One, exactly,
Permanent.
yeah.
In
And so
Sharpie. Yeah.
if we had a client convert money 5 or 7 years ago, I mean, did we lead them astray? Did we cry wolf a little bit? And does that story change now with the bill that just passed?
Well, I say, I
Can't say,
got this
can't say it
question.
depends.
I get this question a lot. And in fact, I kind of look internally. Like we've been talking for years now about the potential for taxes to go up, and you know what? They haven't. Right? They've stayed low, but the reality is they are artificially low. And when you look at the math behind our country, and the growing deficit that we have, first off, we can't even address the deficit. Like the deficit's going the wrong direction, not the right direction. So not only is it a problem to where interest on our national debt is greater than the amount of money we spend on our defense of our country, right? The problem is it's getting worse before it gets better. So if we understand the demographics of our country, we understand the math behind how we spend money as a country. At some point, we have to be able to pay for that. And taxation and tax revenue is the answer there. So to me, if you ask me, did we cry wolf? I say absolutely not. We are preparing for the possibility that taxes, again, keyword could be higher in the future than they are today. They could very much could be. And so the risk is still present, if not even greater in the future. So if you think about like, when we talk about mitigating tax risk and we put it in the same category as market risk, which I do. I truly believe that tax policy presents as much risk to our clients as the market does. And so if we are in an asset allocation strategy and a portion of our assets were in a fixed income yielding instrument that only earned, say, 4 or 5%, and the market did 30%, did we make a mistake in using asset allocation? No, no, because there was still the possibility that the market could have been negative 30%. And that's why we do asset allocation. That's why we hedge. It's why we build, accounts the way that we do. And so we have to take the same approach with taxes, where absolutely the demographics and the math tells us that they should be higher in the future than they are today. And they're going to have to be. But just the fact that they could be is the reason to do this. We're not saying take every penny you own and convert. What we're saying is to go through proper diversification. And if there's opportunity to diversify a portion of your assets over the tax-free side, without assuming too much tax drift and without assuming too many of the side effects that come with a conversion, then it's absolutely the right thing to do for our clients, regardless of where tax policy goes, because it
Right.
could have been there.
Right.
Alec, I noticed while I was talking, we did have a question pop in to the chat. I don't know if you see the questions,
I
but
cannot
I
see.
do. So I'll read it, and maybe we can see if we can tackle this one together.
Sure.
Brent Anderson says, I have a client, healthy, age 77, with $6 million in qualified plans. He's still working. This is a long one. Still working. earning 400 grand a year, RMDs at 300, so lots and lots of income, 55% tax bracket. Should he do a Roth? He's kind of looking at like, man, the break even on this might just be too much.
Sure.
And so, like, let's just kind of try and answer this question from a macro perspective. If you have an ultra high net worth client with a ton of income, should we be doing Roth conversions if they're 77 years old? Uh, I'm going to go back to my answer of what's this? What's the purpose of this money?
Right.
All right, what's the purpose of it? I think people make the mistake of looking at an account and thinking, okay, how much is this account worth to me? And what would taxes be for me on this money? And I think the mistake that they're making is that for a lot of IRA money, especially this client that's got a ton of money um, and getting up there in age, that more than likely a good portion of that IRA money is not going to be for them. It's going to be for the heirs. And so then we have to start looking at, all right, what would my tax rate be for a Roth conversion and compare that to what the tax rate will be for the heirs as they inherit the money. And that changes things quite a bit. And I don't know if this guy's single or married, but Alec, pull up a slide for me. I sent you a document. We talk a lot about widow's penalty, and and I think I don't know. I'm a credit Ed Slot. I think he might have come up with that term, um, but I quantified it. I don't know if anyone has ever quantified the widow's penalty, but when you look at the average client and what they're paying, if you've got a client with $100,000 income and they're married filing joint, then they're at an 11.3 effective tax rate. If we have a death in that couple, the surviving spouse is not only dealing with the loss of a loved one, with a spouse, with their, with their person, they're also going to be dealing with a different tax rate. And now they're filing single, and that 100,000, which a lot of times a budget doesn't change whether there's two or one. There's the spending is still similar, and so if that's the case, now we're at a 16% effective tax rate. That widow's penalty is 4.7%. I'm no actuary here like my boy Marty, but that's a 42% increase to taxes. Not because the government said I need more, not because of the deficit or our national debt, or because of anything other than the fact that our situation drastically changed. And that is massive. And so if we're thinking about clients that are older, that are still married filing joint, and we're starting to think about and consider Roth conversions, we also have an opportunity to convert money under a different tax structure than the money is going to be inherited. Because if we can convert that money a married filing joint and know that the legacy money is probably going to be accessed through a single filer, we got an opportunity to save significant taxes. And you look here for clients that are 100,000 to 500,000 of income, the average increase is 32.4% from the widow's penalty. I don't know about you, Alec, and you see a lot of people running reports. I don't know that anyone's showing a 32% increase in taxes, right? Like, but that's real, and that is unfortunately, not everyone, couples don't die at the same time, and so the widow's penalty is something that everyone is subject to, and it's significant. And with some planning, we can address it and make it a non-issue.
Yeah, and I'd add, Brent. Obviously, this sounds like a very specific case. Let's table this. We'll put some time together, and we can maybe actually run some numbers and kind of see how it looks, and see for
Yep.
this guy if it actually does make sense. Now, the only other thing here that I wanted to expand on or talk about a little bit more is with this in mind, with the big beautiful bill that passed. I kind of thought we could spend some time on like, okay, because if we thought we had this 5 year window or this period of time to convert, what is that now? So like if we're having a conversation with a client now, what is the window we're looking at to convert, and how do we determine that? I guess how do we determine what our most optimal pattern of conversion could be? And I have some ideas on this. I'll let you kind of go, and then we can maybe pivot to some numbers here to look at this as well.
Yeah, it's to me, a lot of people are starting to talk about Roth conversions. A lot of people think they can just execute them on their own. They're like, hey, I got a Schwab account. I can file some paperwork, do a Roth conversion. I'm good. I think as an advisor that truly understands the the details and the side effects that come with a Roth conversion, you really have an opportunity to set yourself apart. And we've tried to build that into the Roth Done Right software so that you can really, I'm not the smartest cookie out there, but with a little information, I can really seem informed when I start talking to my clients, and that's what we're trying to do here with this. Um, and pattern or conversion period or how much we're converting each year, it can be a real differentiator for you if you understand it. Um, to me, if we're talking about a permanent tax change, right? Like, I mean, you just cannot say permanent without using air quotes. But it becomes a real question. Like, okay, well, how much are we going to spread this out? I don't want to pay any tax drift if these tax rates are going to be long term. Let's spread this sucker out for a while. And yeah, maybe we can. But how long is too long, right? The last thing you want is to spread out your conversion so much that suddenly that those permanent changes aren't permanent anymore. We got new administration in the White House. We got changeover in Congress, and suddenly some reality is starting to set in on where tax rates really should be, and we missed a window. So to me, what I like to look at is could we spread it out a little bit more now? Yes, I think the new legislation does give us some more runway on our conversions, but that doesn't mean wait. I think it means start right away, start converting. But maybe we can go like I like to run our reports now, and we're going to update the defaults in the software to this at about an 8 year, assuming taxes change in 8 years. Where did I get that from? Well, down the hall is Becky's office. Alec mentioned that she did a State of the Union last couple of weeks, and she looked at the historically what have been how long has quote permanent tax policy lasted, and she gets mad at me every time I talk about this because it is very broad. It's certainly broad. They could last a long time. And also, tax change can come in different forms. They might just change certain brackets, and that seems maybe likely where taxes might increase for the wealthy, but not for lower tax payers. But what I like to use is 8 years because, as Becky stated, permanent tax change tends to last 8 to 12 years. And so if we are mitigating against the risk that taxes could change, I kind of like to be on the shorter side of that because again, and Alec's going to talk about this on how we can kind of run the reports different ways, like multiple scenarios to run a couple of what ifs. And to me, becoming a master of the software is doing that. But I'd like to kind of think about 8 years because that, even though they're permanent, permanent ones tend to last about 8 to 12. Well, let's be on the shorter end of that because we're trying to mitigate that risk. And let's just show what that risk could look like in terms of quantifying, the taxes going up. Alec, you want to expand upon that a little bit with
Yeah, for
maybe
sure.
reports that you've run
Yeah,
to
and so I think there's some ways we can quantify this too. So I'd say one, and just to elaborate a little further on what Neil said, right? In the software when you're running and I'll get into this here in a second. There's an opportunity. You have the option to show taxes increasing when you want. You have the option to choose an optimal conversion or a conversion pattern. The software will also run some numbers for you to tell you is there a more optimal pattern. If you chose 5 years, is 7, 10, 3, is it better, right? And so much of that's going to be circumstantial based on when they retire, their income, all sorts of things like that. But the question of now of, well, when do we show taxes going up? Because if you asked me this on a coaching call in 2024, I would have said, hey, January 1, 2026, we're showing taxes increase, right? We know that was going to happen. Well, in January 2025, that conversation changed. And so now it becomes more of like, well, we don't really know. And I honestly think, putting in the permanent tax cuts does not indicate actual, that it's going to be here forever. And I think we all probably are aware of that. And so what we've done, and I mentioned Becky kind of dug deep into this, is you look back at history and look at when a permanent tax cut was put in place throughout history, how long have those last? And I think the longest, and I might mess this up, I think it was JFK's was like 16 years, but on average, it was somewhere in that 8 to 12 year window. Well, the only difference was 40 years ago, 50 years ago, we didn't have $40 trillion of debt. So there's a lot of, I would say it's a little harder to plan for, but I would almost make the argument that the risk today is higher for a client in terms of it's there's more unknown than we had in 2021 or 2022, right? It was a little, it's harder to plan for today. So it could be 8 years, could be 12 years. Now, also there could be an administration change at the next election cycle, and it could be, I don't know, it could be 4 years, right? There's so much that is unknown. So I want to kind of walk through an example though, because I think it's important to be able to quantify that to your client. And so I've run kind of three different variations of our Roth Done Right report. And I want to kind of analyze the differences. And if you're not familiar with this report, we won't spend the call going through all this. That's not kind of the goal of this. If you want to chat about it or know if you got it or learn about it, book some time with me or reach out. But I've run three different examples, all on the same type individual. So I kind of made some numbers up. We got a 65-year-old client that's planning to retire in a couple years. We're converting $500,000 of their $1.5 million IRA. That's kind of the only important part to this. But what I've done is I've modeled tax changes three separate times. So the first one I've run it once, what if taxes don't change? And what is an optimal conversion pattern? And then I've said, well, what if they change in 8 years, right? Like Neil suggested. Because the reality is, if we're looking at a conversion for a client, conventional wisdom suggests the longer you spread it out, that maybe we can get away with paying the least amount of taxes to keep that tax bracket low. But if we're doing a conversion over 10 years and taxes go up in the seventh year and we haven't accounted for that, we're going to pay more in taxes. And so I've run three different examples here. All of them I've modeled a 5-year conversion. But a cool part about the report is it'll run for you whether the tax is paid on a 1-year conversion versus 5 years and or versus 10 years, all throughout. And so if we look at an example here, I've modeled a 5-year conversion. And this says, okay, if we converted this $500,000 IRA over 5 years, we're paying somewhere in the range of around $135,000 with taxes and fees from IRMA. Now, excuse me, if you look at the differences here from years 1 to 10, years 1 is 185,000, but year 10 is 125,000. And we kind of see some trend downward. There's a little bit of changes here in 8 or 9 based on maybe Social Security or RMDs or something kicking in for whatever in this example. But this would actually suggest that 10 years, if taxes don't change, that the longest we spread this out, the longer we keep doing that, the lower the taxes would go. Now, and
Alec,
that's
also speak to that new column we added, the one after it. It's like
the
the
total wealth
total wealth
generated.
generated. Yeah.
Yeah, so this also would suggest, and we'll kind of get into this a little bit on the next part on the break even on if you die in a given year, actually how much money are you leaving behind, whether in the Roth, and we are able to compare that to the IRA when we're looking at either if they've taken income or not. So that is that's a new column there that I think really plays well with the break even page that we've spent some time on. The only other piece of this though, and this example is, and I'm going to make sure we clarify this. This number was ran 10 years was the optimal pattern with no tax changes. And if we ran that out another 4 or 5 years, it might keep getting lower and lower. I would suggest, convert this money take as long as we can essentially for the 65-year-old.
Well, maybe if you don't think taxes are changing, maybe you shouldn't be converting, right? Like
Sure,
what are
sure,
we doing
absolutely.
here?
Right. Now, the other part of this, the next one I'll show is going to be looking at what Neil suggested. Well, what if taxes go up in 8 years? Okay. And so this is going to be our default assumption in the system. And this is kind of the question that led to this question at this point was, well, when do we show taxes rising? And what I always tell people is, we're going to have our default. You can run the default whatever you want, but I'd also say you're going to want to find a story and a message you're comfortable with your clients. And so in this case, if we look at an 8-year increase here, taxes going up 30%, which would just be taking them back to where they were before. If I go back down here to this optimal conversion pattern, where we still continue to see the trend of decrease, 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 but now 7 years is the lowest, where taxes went up in year 8, and in 8, 9, and 10 are no longer the optimal pattern of conversion, right? And so, which makes sense if taxes go up, even that in that case for this individual, their income's lower, we're spreading this out, but taxes are now higher. And so if we have chosen the 10-year difference, and in my examples, it's not a huge difference, right? It's 125 versus 136, but that's still, that matters, right? And we're making projections on how much we think they could go up. It also could go up more, it could go up less. Now, an interesting part for this to me though too is like I ran an example that said, well, what if taxes went up in 5 years? And to me, this kind of school of thought is, well, what if we get a new administration at the next election cycle? Let's say it takes them a little bit of time to phase it out, and in 5 years, taxes increase. Well, now our software would suggest the optimal pattern of conversion, and this guy was still working for 2 of these years, is now actually the fifth year, 142,000. And the difference in that case between year 10, my no increase was 125, and my big increase in my 5 year increase now says 147. So in that example, we're talking a variance here of 15% of this account, right, of the total taxes they could pay versus if we do this correctly versus incorrectly. And so to me, this is the risk that we're mitigating for the clients, right? And so when I look at this and you see an example, whether it be 8 years or 5 or 7, whatever, the difference in the numbers, when we're talking about, maybe here, like 129 versus 136, 135, we're talking about $4,000 or $5,000. I'm in the camp of still, we know what taxes are today. We know at some point in the future, the relatively near future, they're going to be higher. I still am in the camp of like let's convert in a reasonable, efficient manner that still takes away some of that risk that we're unaware of down the road. Now, the other piece I'll add to this, and anytime I run this report and coach someone on it, I think to me this is my favorite part of our Roth Done Right report, because what I think this allows you to do as an advisor is kind of flex your muscle with the client on here are all the factors that we consider when it comes to a Roth conversion. And if you do a call with me separately, we'll detail out the report a lot more than we've done today in some of the other pages. But essentially what all the things this kind of looks at, what are the factors that influence a Roth conversion? What impacts the amount of taxes and fees we pay? And so the first one, being tax drift, which if there's one that a client's familiar with, it's probably that, right? Like this is why we wouldn't convert money in 1 year or 2 years. It puts us in the highest bracket. So we're paying significantly more taxes than we were if we spread this out. The next one I'm going to is that IRMA drift. And so IRMA is the IRMA fees that we pay from converting the funds. And so there's we model those out. But the one we're discussing now is this conversion delta. And that is when, could taxes be higher in the future? And if they do, right, the impact could be. So if I coach people, I'd run this two ways. I'd say like kind of what I've done here. Here's the three scenarios. What if they go up in 5 years, 8 years, 10 years, and we can kind of look or no change at all really and see, these are the things going to influence our decision. So I look at this and I'd say, maybe if I run this at 5, maybe you go rerun this at 7 so you get the lowest number. But this is where I'd say, here's why all the things that we've done to make sure that we're preparing the most efficient and effective conversion for you, right, to minimize the taxes and fees we can pay. And if they're one trying to do this on their own, or they're working with an advisor that is not talking about, that is only looking at tax drift, that's not considering conversion delta and IRMA drift, well, like if you just look at the difference between like the least efficient conversion and the most, we're talking $50,000, $55,000 more taxes paid. And that is
Alec, how
substantial.
much are we converting in this example? Is it 500,000?
Yes,
And we assumed what, like a 5% growth rate, 6%?
5%.
Yep. Okay. So like that, I think that's important in perspective here when we're talking about, saving 50 grand. Like that's 10% of the account value there. Like it's a
Absolutely.
significant amount. And you start looking at like the way you differentiate yourself an advisor. If you could come in and say, hey, I'm going to get you a 10% more return on your money, 100 out of 100 people are going to work with you. Well, what you're saying is I'm going to get you even more return on your Roth conversions because of the information that we have when we go to structure it.
And yeah, so I mean that like I think that to me this is like the most powerful way to use this is to where when we're talking about this risk of taxes being higher in the future, when we can actually quantify what that impact would be. Now keep in mind, and we're making assumptions, right? Like we're making assumptions on when they're going to go up. But history has shown, and reality is that we know, we don't have to be an economist to understand that we cannot sustain this level of debt that we're at, and a place where they're going to look for that is going to be tax revenue. Now, one more piece from this and I guess we'll kind of pivot off of this kind of next, because I think a question I had a call with this morning with someone that kind of I think leads perfectly into this, and the question was around like essentially like time value of money was what was an objection he got from a client was if I convert this money now, how long or when will I have more money in the Roth than I would in the IRA, right? We're saying you pay these taxes today, and I'm taking a cut, if you will, and then how long until when does it break even? When's it worth it? And for Neil, maybe for you, I'd like elaborate one on maybe kind of your thoughts on that, what that means, and then I think we can actually dive into the software a little bit and kind of quantify that too.
I'm sorry, I was reading one of the questions on the side here. We got a case question, but what is it you want me to elaborate on?
I was saying the question was around like time value of money and this
Oh,
Roth
yeah.
breaking even, right? Of like
Yeah.
when does it become worth it for
Breaking.
me to put my money in a Roth?
It's funny. When we put out the Roth Done Right software, the immediate response we got from everyone that was using it was like, "Man, you guys are 95% there. Like, what a great report, but you're missing something." Because the initial report, it just calculated the taxes and the IRMA, and everybody told us, "Yeah, but what we really want to know are the values. Like, are we winning this thing from an account value perspective?" So we went immediately back into the factory and created a break-even analysis. And um, what's interesting to me on the break even analysis, it gets even more important on what your assumptions and what your inputs are. If we're talking about IRA money and my client is 60, we haven't used the IRA yet, right? So we're going to look at a statement, but we haven't used it yet. But the value that we're really looking at is if we were to pass on, like if all of this money were to be assumed right away, what would what would it be worth, right? We have to look at the after tax value of that. Well, if it's IRA money, especially legacy money, like that's a different tax rate. That's the heirs. So, we also added an input into the software that's going to allow you to input an alternate tax rate for the heirs. And that suddenly became the single most important input in the report because the majority of the IRA money is not going to be paid. Like, we ain't paying those taxes if that money's going on to the kids. So, so to me, that's crucial. And so then we started looking at, okay, well, what should I put in there? Are my heirs going to have the same tax rate as me? Is it going to be higher? Is it going to be lower? What's it going to be? And again, it matters. But for a lot of people, this is where we're subject to that widow's penalty. And we just kind of went through that. Remember, if we're a couple and suddenly we're single, filing single, we're looking at, on average, a 30% increase to our effective tax rate simply because now we're single. Well, we should reflect that. And so we need to put that. And so when we're looking at a break even analysis, ultimately it's like who's inheriting the money and what's that tax rate going to be. Now, maybe other people say, well, it's going to kids. Well, for the kids, it could be worse, right? Because they might be in their prime earning years of, and they have to assume that money now in 10 years. And so suddenly that's not the widow's penalty, but that's now the 10-year tax trap. And when we're looking at, um, the taxable assets of an IRA passed on to the kids, we shouldn't really be looking at effective tax rate because we've already calculated their income on an effective tax rate. Like, all of that's being taxed at the margin, right? So now we're looking at marginal tax rate. And again, it's a much higher rate than what we would just model for ourselves. So I know that's not the exact question you asked, Alec, but to me, when we're looking at the break even analysis, we really got to look at that heirs tax rate because a majority of the IRA money hasn't been taxed yet. And so that's the rate that's going to be used. And when we
Sure.
use a realistic, reasonable number that takes into account 10-year tax trap or takes into account widow's penalty, break even actually becomes like immediate because we're avoiding those higher tax rates on the Roth because we're paying them now at known rates, at our own rates, at married filing joint, and not at single.
Sure. Yeah, and I think, and we have a good way to elaborate this too, as you mentioned on our software, and so I think the examples I showed before, I'm going to walk through those once more. And I'm going to show two versions of this. So again, on one I had shown, right, I ran examples of taxes increasing in some years versus not. So we have our break even analysis here. And just to expand a little further on what Neil said. So this example, this guy's 65. And on this report, we kind of look at, well, what if you defer as long as possible and take your RMDs? Or what if you start taking a level income stream when you retire at whatever given age? In this age, it was 67 in this example. So that's what the two sides outline here is, okay, taking an income at 67, or on the left side, waiting until RMD age. Well, the point you were making is if this guy's 65 and we said, hey, you got $500,000 in an IRA, that money's not been taxed yet. And if he's not accessing it, it's not being taxed. So how do we quantify that? And so what we've done in this example is we assume, the way we quantify that is we assume death in a given year. So it says, okay, if you were to die today, what is the after-tax account value that you're leaving behind? And the results of this report is going to be greatly predicated on the input that you show at tax rate at death for beneficiary. And this is, as Neil mentioned, you could probably make an argument here. I put in 25%. That's pretty conservative in my opinion. Neil showed the chart of how big of an increase it is. But, this is also a little bit of a difficult thing to predict, especially, you got a 65-year-old client. We hope this guy lives another 20 some odd years. They say, hey, what's your kid's tax rate's going to be in 20 years? We don't know. But when this guy's 80, his kids are, let's say, early 50s. They're probably in the primary years of the career, like Neil suggested. And if they inherit this money too, on top of their current likely highest tax rate they've ever been, a $500,000 IRA that's growing at 5%, they might inherit $1 million, and they're going to have 10 years to take that money out. And if they don't need it, if they wait a couple years, then it kind of gets even bigger. And
And
so
tax at the marginal rate.
absolutely. And so I've shown 25% here for this example. And so what this says here is this looks at, and I'm just going to focus on this left side for now, is all right, at 60, you're 65 today. If you die, you leave this money behind, and the tax rate your beneficiary pays is 25%, you're leaving behind $393,000. Well, if we had converted, and this was assuming this was a 5-year conversion. So if we have done 1 year of the conversion at our client's rate, so let's say this is 500,000 over 5 years, so 100,000 was converted at our client's rate. The remaining 400,000 was taxed at the beneficiary rate. We'd be leaving 391. That's likely because this client is higher than 25% rate. Now, what this suggests, though, is that actually at age 75, this is when the Roth breaks even, if you will, right? So we have a larger account balance in the Roth. And now the way we quantify wealth generated is, in this case, if they start taking an RMD at 75, what this is calculating at age 80 is saying, okay, we've taken 5 years of an RMD, and that was taxed at the client's rate. And then the remaining account balance was taxed at the beneficiary rate, and that is the number here that was put out. So it's including any income taken that's on both sides, whether it be through an RMD or through an income amount. So in this case, it says, okay, Mr. and Mrs. Klein, if you live 11 years on the RMD side, leave 11 years, you can have you'll have more money in the Roth than you would in the IRA. On the level income side, it's a little bit sooner. If they start to take a distribution, it's after 8 years. Now, I ran another example though, because the other part of this, if taxes go up, this does impact these numbers. And so just on the example of taxes going up in 8 years, if taxes going up in 8 years, instead of taking 11 years to break even, it drops down to 8. So 3 years are cut off on when it breaks even. And on the 5-year, I didn't even look at this one yet. On the 5-year, it actually would just take 4 years to break even, right? And that's not even having all the money be converted yet. So all these things are going to impact the way our money is taxed when it's left behind, whether it be the tax rate of beneficiary as well as whether taxes go up in the future. It impacts whether we're taking income or not. It's going to impact our total account balance, and we're seeing here that throughout retirement, and really in all scenarios, if they live past, I think 75 was the age here, you're leaving more money behind in your Roth than you would if you keep it in your IRA. I know there's been some things going through. I've seen some hands go up. I'm not seeing a lot. I can't see anything in the chat. Do we have any questions coming through that we can talk about?
Well, a couple, but I want to encourage our listeners here. We're going to take questions through the chat box here. So either use the chat functionality, or you can type your question in. We're not going to be able to go to you live to actually ask your question live here. We're just not quite that sophisticated. Maybe Alec is, but I'm not, and I'm the one driving this bus.
Yeah, I cannot do it with my
But we got another question about a very specific case. So I don't want to go into the details, but Alec, why don't we use this as kind of a broad, how do people get on your calendar or my calendar to do case consults? Because we got a very specific question about a 62-year-old with 400,000, this and that. I can't really answer that on the broad here, but why don't you talk to them about how we do coaching and how people can get on the calendar?
So if you're a Stonewood member, one, you've probably gotten emails from me before. If you haven't, just reach out. I'd love to chat with you. But if you're a Stonewood member, it's part of what's included in membership. And so when you log in, anytime you log in your Stonewood account, or you go just simply to stonewoodfinancial.com, on your Stonewood account in the top right, there is a contact us page. And if you go to the contact us page, you'll see here, I'll share my screen with you. Um, the screen share's a little slow. One second. There it goes. I'll share my screen with you. You're going to see access availability to my calendar link for onboardings, coaching, and training. And then if you scroll down a little bit, you'll see access to Neil's link as well. And so any of that, you can feel free to, if it's specific, I want to run through the software, I need to train my staff on this, I have questions about my account, my information, how we use it, certainly reach out to me, book time with me. And happy to walk through any of this stuff with you. And then also, if you have a really specific case question, feel free to certainly connect with Neil, shoot him an email, or try to book some time with him as well.
Yep. One of the I did read through the last sentence on the question probably does make sense for us to talk through a little bit. Our software, we're analyzing IRA money. Obviously, IRA money has required minimum distributions. So the question is, do we have to show the RMDs on the income tab, or does the software automatically capture that? I know the answer, but I'm gonna let you say it.
I'm going to make sure I understand your question. On the income tab, ask the
RMDs,
question.
are RMDs already automatically accounted for through Roth done right? Do we automatically show them coming out of the IRA?
Answer is yes. Yes, we
Yes.
do calculate the RMDs, right? Yeah, so we account for that. And so the way the report breaks down, it runs two scenarios. It says, well, what if you defer as long as possible and you just wait and take your RMDs? The other one says, well, what if you retire at whatever retirement age you put in and take a level income? And if that level income does not, in almost all cases, the level income will exceed the required minimum distribution. So we run
Yep.
both scenarios of what if they're taking an income from it, or what if they don't and they just take out the RMD.
Yep. And then, I mean, I'm going to do a follow up question to this guy's question, which is for cases where we have additional IRA money that's not being converted. So
Sure.
if you got $1.5 million IRA, we're converting 500,000. There's still 1 million out there that's going to have RMDs. Software
Yep.
also automatically counts for that.
Correct. Yeah. And so we assume that, and I'll save spare getting too into the weeds here, but I'll kind of show a quick example of how that works here. When, in the case of this example, $500,000 IRA converted of 1.5 million total. The way we essentially treat that is the results of the taxes paid. Those are always going to be on the 500,000 you're converting, but we need to know about the other IRA dollars because we assume that comes out through the RMD process. And so if you ever go look at that, like the way we essentially treat it is we want to treat it as if we got like essentially one account that has 1 million in it, one account that has 500,000 in it. And so like on the tabular data here, where it's like calculating the RMDs, at 75 here, the IRA income, this is the RMD on the 500,000. But if you ever notice the AGI, that's going to be like Social Security income, any additional income coming in, and then the RMD kicking on. So in this example here, at 74, he's making 76,000. Well, then that bumps to 145. That's because the other $1 million RMD came out, and we need to know that because that takes his tax rate from 23 to 29. And so if we weren't accounting for that, we'd be missing a substantial amount of
Right.
taxes he'd be paying. So that's why we ask for that total IRA amount, and then we run the numbers on the 500,000, but we need to know about the other dollars, so we include that for their taxes.
Yeah, we're trying to get to the truth as in as few inputs as possible, and so it's where we kind of make some assumptions on that, and that's how we assume that other IRA income is being treated. So, Alec, we got 49 minutes here,
I
man. We've
know,
been
I know.
going at it
You
a
let
little
Neil and I
while.
get on and talk. We're going to take up the whole time.
You know that's happening. We do still have a healthy number of folks still on the call, so I appreciate everyone sticking through, being part of the Stonewood community. This is one of my favorite things that we do. We get in, we interact with you, and the best thing is for you all to book time with us so you can tell us, what's working. A lot of the stuff that we've talked about today was a result of conversations that we had with members saying, hey, man, I wish you guys would have thought of this or that. And a couple weeks, couple months later, it's actually built into the software. So, Alec, any parting shots before we say goodbye to everybody?
No, Neil, and I can't do it, but if you want to, I put in the chat to you the contact us page. If you want to put that out there in the chat for anyone that wants to reach out, send us an email, book time on my calendar, that'd be a good way to follow up. I know that sounds like there were some specific case questions in there, so if you have that and want to walk through that with myself or Neil or someone else on the team, Neil, you sent that only to me, just so you know.
Yeah, I
Uh,
see that. Yeah, I told you we're challenged here, my man.
there should be a drop down option where it says to, and you should be able to click who you want to send it to.
See, the only person in life I need to talk to is Alec here. He is my default. I,
I
uh,
tell you what, we can just send out a follow up email saying, "Hey, here's the recording. Come book some time with us." Also, I'm sure. Hopefully, most of you probably got emails from me too. So if you have questions,
yeah.
don't hesitate to reach out. We're here to help. That's kind of why I have a job here at Stonewood. So happy to do it.
All right. Thanks, everyone. I hope you're having a great time surviving the summer and look forward. We are pushing live. Just quick plug. We are pushing live here this week, starting into next week. Registrations for our Mastermind Innovate events in the spring. We have a massive event. We have 100 of members that come in. We got a full sponsor room. We got everything. In the fall, we're trying something new. And we thought, what if we made it smaller? And we're going to do more of them. So the goal is to have 3 of these mastermind live events right here in our office, right outside my door here. And so that means we have to cap it at 16. We're going to do it 3 times though. But make sure the dates are already on the website, but be getting emails from our team. Make sure you book that time. We'd love to have a nice interactive group of our members that are using the software, that are talking to their clients about legislative risk and tax risk, and have a really healthy meeting. And those are going to be starting late September, early October. Make sure you book that and register because we'd love to see you.
Yep, you'll get an email on that next week, but you can go ahead and register for that. Look at those dates on your Stonewood account under the training and upcoming events tab. You can find all that. Next, any webinars we have going, but also the live events we're doing in our office, those are posted there and you can register. And so go ahead and do that.
All right. Thanks, everybody. Appreciate all your time and look forward to seeing you soon. Take care.